Are you a better than average driver? Chances are you answered yes. That's because nearly 3/4 of people think they are better than average drivers. Besides being mathematically impossible, this statistic is an example of overconfidence, and it's just one illustration of how certain biases can influence our thought patterns. In this video, we'll talk about 3 of the most common behavioral biases and how they can impair our investment decisions. Behavioral biases can sometimes cloud our judgment and cause us to make irrational decisions. This is especially true when it comes to investing. At a time when the markets are down and it's impossible to predict what tomorrow will look like, our perceptual distortions can make a difficult situation worse.
The first bias that we will cover is anchoring. You've fallen victim to anchoring when your emotional attachment to the past value of an investment keeps you from recognizing its present value. For example, let's say you own a stock that was recently selling for $100 per share, but has since dropped to $60. You may be anchored on that $100 figure, convinced it's the right value for that stock. As a result, you may hold on to it, convinced it will soon rebound. However, there's no guarantee that will happen. Secondly, let's talk about recency bias. Recency bias can lead to putting too much emphasis on the latest information and often ignoring other important data. For example, say stock prices begin to climb, and that inspires an uptick in buying. As investors pile on, prices climb even higher, surpassing historically expensive levels. Investors will ignore these red flags, assuming that recent trends outweigh other long-term data. However, bubbles like these can pop, and falling prices can potentially leave investors with heavy losses. You can avoid recency bias by taking a long-term approach to investing. Strategies like dollar cost averaging, when you make a series of regular investments, regardless of the market's ups or downs, can help erase the temptation to chase returns or panic when prices fall. The final bias we will look at is overconfidence. Confidence is useful and in many cases necessary. Investing a chunk of your income in the stock market takes confidence. And it's confidence that allows you to put risks in perspective and sit tight in a turbulent market rather than rushing to sell your assets and locking in losses. But overconfidence can be dangerous. It can lead you to believe that you know better than the experts, that you can predict market movements successfully. Spoiler alert, you can't. Or that you can spot investment opportunities others cannot. Worst of all, it can lead to emotional decisions in response to market moves.
Recognizing how behavioral biases influence investing can help you keep them in check. As a result, you may be more likely to make investment decisions that align with your long-term financial plan rather than make irrational decisions that may knock you off track of that plan. If you are seeing ways that biases have played a role in your financial plan, please give us a call. We'd be happy to provide some deeper insight.